And so then I just started musing and I thought, yeah, let me just think through like how much, even if everything goes right for Bitcoin, what's the most it could appreciate, let's say by the year 2050. All right. And I just ran some numbers. It actually surprised me that even with throwing in what I thought were generous assumptions, Bitcoin, I don't think can possibly match the performance that we've just seen from it.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I'm going to do something that may anger you if you're a Bitcoin maxi, but hey, I'm here to give you the truth. I'm just the messenger. So specifically what I'm doing is I want to provide what I think is a pretty plausible upper bound on what the average price appreciation of Bitcoin can be over the next 25 years. All right, so that's what I'm doing. And the genesis of this is I was just talking with some people recently, and we were talking about how Michael Saylor, he's basically just, his company is just holding Bitcoin, and a few other people that we know, they just basically think the only real asset to be in the near future is just Bitcoin. And so then I just started musing and I thought, yeah, let me just think through how much, even if everything goes right for Bitcoin, what's the most it could appreciate, let's say by the year 2050. All right. And I just ran some numbers. It actually surprised me that even with throwing in what I thought were generous assumptions, Bitcoin, I don't think can possibly match the performance that we've just seen from it. So just to give you the benchmark, in case you're not familiar with it, I mean, there's one sense in which Bitcoin has gone up infinitely since 2008, right? Since that's when the white paper came out, and effectively it had a price of zero at that point. But let's, to avoid absurdity, just pick something of a shorter time frame. So from 2014 through 2024, depending on when exactly you clock it, basically Bitcoin went from $50 to right now, as I'm recording this, it's around 67,000. All right. So over that 10-year span, that was an appreciation of 133,000% gain. All right. So if you annualize that out, that is roughly 105% gain per year. So in other words, Bitcoin on average more than doubled every year for 10 years in a row. Now, of course, it was very volatile, so it didn't just keep doubling. But I'm just saying, when you see price appreciation going from $50 each back in 2014 to now 67,000-ish just 10 years later, that's incredible. All right. And still, Bitcoin is in its infancy in terms of what its proponents think it's ultimately destined to become. And by the way, I should mention, so am I. I'm a huge fan of Bitcoin, and I think that its best days are ahead of it. I think in general, blockchain-based finance is going to revolutionize planet Earth. That's partly what we're doing here at Infineo. We're taking real-world assets, we're starting with life insurance, and putting it on the blockchain, or putting them on the blockchain. And so that's what we're all about here at Infineo. So I'm a huge fan of this whole space. And I'm a fan of Bitcoin itself, not just for nostalgic reasons, but also I think in many respects it has superlative qualities as a money if there's more widespread adoption of it. Okay, so I want to stress for the Bitcoin maxis, the point here isn't to denigrate Bitcoin. I just want to make sure you see that I don't see how Bitcoin could do a repeat of the last 10 years going forward. That's what I'm trying to get across. Okay. So having said all that, it's still, as we'll see, I think there's still a huge potential in it. And for people who just want to hodl, I'm not saying you're wrong. I'm going to try to gain some more Bitcoin myself. Okay. But I'm just saying these calculations as we go through this, if you think that I'm off, then I just encourage you go through my chain of reasoning and point to the specific assumptions I'm making where you think I'm underestimating what Bitcoin might do in the next 25 years. Okay, so again, big picture, I'm just going to go through. This is very back of the envelope stuff, of course, but I think what I'm doing here is not, you're going to see, it's not underestimating how Bitcoin might appreciate in price, just to this idea of could it just have another run where it doubles every year on average for a long stretch? I don't see how that can happen. All right, so the first thing, let me just spend a few minutes on is just when we think through a stabilization point, that right now there's sort of this self-fulfilling prophecy where more and more people are going to start piling into Bitcoin because its price appreciation has been so impressive. And in particular, more and more people might adopt the hodl strategy. For people who don't know, somebody mistyped it apparently like on a Reddit board or something, and it was, they're trying to say hold, H-O-L-D, and they flipped it to H-O-D-L. And so now in the Bitcoin community, hodl is like the motto to say, just get your Bitcoins and hang on to them. I don't care what your financial situation is, just hang on to those things, because trust us, 5 years from now, looking back, whatever reason you thought it would be a good idea to sell some of it, 5 years from now, you're going to think, why didn't I hang on to that? Okay, so that's kind of the idea. But clearly, that can't last forever, right? If everyone just keeps accumulating Bitcoins and then never sells them, that doesn't work. The whole point of something that's supposed to be a superior means of payment, or even as a store of value, that doesn't work if nobody ever sells the thing. Okay, so there's that element. And so what I'm trying to show is, if Bitcoin is ever to achieve its original vision of serving either as a global payment system, or given the transaction costs and so forth, people are now pivoting to say it's more like Bitcoin will be the future gold bars that are in vaults around the world, that kind of thing. And that it'll just be like the ultimate means of settlement, and maybe more day-to-day transactions will be layered on top of that, whether you like Lightning or some other way of doing it. Still, to get to that state, it eventually is going to have to be the case that the typical Bitcoin holder isn't a hodler. Again, I'm just restating, it can't be that for the rest of time, as new humans either get interested in Bitcoin or are born and grow up and their parents teach them about it, and then they take over the family motto of hodling, Bitcoin then wouldn't actually be serving any function if all people ever did was hang on to it. So the only way it can ever live up to the vision is if we get past the hodl stage, to when then it's being used, again, either as think of it as a currency, or as something that's a little more esoteric, that like a long-term store of value, something like that. Okay? So what I want to do is just say, let's jump ahead to that point, and let's just assume it's 2050. And I think that's generous on my part, right? So we're going to see with the way I'm doing these calculations as we go through this, the sooner I pull that forward to say that we've now moved beyond the hodl phase, and now Bitcoin has just matured, and now it's not going to have these rapid price appreciations for speculative purposes, because now everybody's adopted it. Once we get there, then its growth in terms of price appreciation has to settle down. That, restate the argument, because it's kind of critical to make sure I'm not losing people at step one in my chain here. What I'm saying is, right now, there's a small group of Bitcoin enthusiasts who think the rest of the world doesn't get it yet. We know 20 years from now, way more people are going to be holding Bitcoin and possibly using it for commerce than are right now. And so that's why we're getting in early, even though it would have been better to get in 10 years ago. Still, getting in now, it's relatively early in its maturation. And I am okay with thinking like that. I think like that too. And if I introduce people who are new to Bitcoin, that's partly what I'll say is, I think future historians looking back will mark 2008 as a significant point in the evolution of money and commerce for human beings, 2008 being the release of the Bitcoin white paper. Still, in this interim phase, there's a lot of people holding it for speculative reasons. They're holding it not because it's a means of payment, and not even because it's a store of value, but because they think it's an asset that's going to shoot way up, that it's relatively undervalued right now. That's the idea. Think for a second in terms of gold bars. If you're somebody holding gold as an inflation hedge, that's different from holding it because you think it's undervalued. The two in practice can go hand in hand, but strictly speaking, if you just have some of your wealth in the form of gold, it need not be the case that you think, oh yeah, I think gold's going to go up 20% next year. You could say, no, I don't know if it's going to. I'm just holding it in case the dollar crashes or the euro crashes, and then I want to not get wiped out. So this is more of like an insurance policy. Okay, so there's that element. That's what I'm trying to disentangle here. People right now who are hodling, I think it's largely because they think it's for speculative reasons that, oh, Bitcoin relative to other assets right now is going to surge because it's undervalued compared to what I think its long run true fundamental value, or whatever phrase you want to use, is. Okay, so I'm saying if we're trying to understand what's the ceiling, what's the most we could expect, I'm saying at some point, once all of planet Earth has fully adopted Bitcoin as much as they're going to, then it stops rising because more people are piling into it and it just tapers off. And then at that point going forward, it's just now serving its intended role as the number one means of payment or store of value for human beings. Okay. So that's where I'm coming from. And again, I'm saying by pulling that forward in time and saying, let's assume we hit that by the year 2050, I'm being generous because that's going to give the upper bound on what Bitcoin's value can be, like its market cap. As we'll see in a minute, I'll spell out how I'm coming up with those calculations. And so then when we want to know what's the annual rate of appreciation to get to that point, the sooner we pull that forward, the higher the annual rates of growth are. Whereas if we push that out and say, okay, in practice, probably we won't get total global adoption until the year 2070, you can say that, but then that's going to hurt your case if you're a Bitcoin maxi and think that, oh no, this thing is going to rip. Okay, I'm just making sure you see that. So that I'm, by pulling it forward and saying, let's assume we get total complete adoption by the year 2050, I think we can all agree that's generous to Bitcoin. And I'm saying that's not biasing my estimate. That's actually bumping up what the annual rates of price appreciation will end up being in this completely back of the envelope exercise that we're doing here. Okay, so let's just assume for the purposes of this quick little exercise, just to get our heads wrapped around this concept, that as of the year 2050, Bitcoin has replaced all of what we now call M3. All right, so M3, it's a particular monetary aggregate. So M0 is the monetary base. That includes actual currency that sovereign governments issue, like Federal Reserve notes or paper currency euros issued by the ECB, the paper yen issued by the Bank of Japan. It's that, and then also it includes commercial banks' electronic reserves on deposit with their respective central banks. All right. M1, which is a broader monetary aggregate, includes the paper currency and the public's checking account balances. All right. So M1 is the closest to what people think of as money in the hands of the public. That you personally in your daily life, when you think like, how much cash do I have? You probably think literally the currency in your wallet or purse, like if you're in the US, $100, $50, $20 bills. And you probably think, what's the balance of my checking account? So you don't mean how much is my house worth? That's clearly not how much money you hold. That's just part of your wealth, but that's not money. But typically people in everyday life, if somebody says, hey, how much cash do you have or how much actual money do you have? They don't just mean the green pieces of paper, if we're talking about the US, but they probably also mean, oh yeah, if I go to the ATM and put my debit card in and pull up what's my balance on my checking, that says I got $418 there. So add that to how much money do I have, right? Okay. So that's what M1 corresponds to. M2 adds in savings account, other time deposits, and then M3 is even broader, and that includes things like money market mutual funds. Okay, so the reason I'm just picking that just to give us a frame of reference is I think Bitcoin, because of its attributes, can fulfill all of those functions. The reason that people in the real world right now both, hold physical currency, have checking account balances, have savings account balances with their banks, and even have money market mutual fund accounts, I think all of that stuff, all of the functions that those different types of assets are serving could be replaced by Bitcoin. Again, I guess I'll deal with it right now. There's an issue of transaction costs. I'm going to abstract away from that in this analysis. And again, I think I'm being very favorable to Bitcoin if I'm doing that. So basically I'm saying, let's suppose there's a costless way that people come up with being able to transfer titles to Bitcoins so that there's no drag, that it's just this pure system that operates without any cost to the user. All right. And again, that's, I hope everyone agrees with me. I'm being very generous by saying that. Okay. So that's the sense in which I'm saying I think Bitcoin, you could say it could replace all of what's currently fulfilled by all those items. So right now, what does that look like? Various estimates bounce around, but for our purposes, right now, there's like $8 trillion in actual currency on planet Earth. Obviously, they're denominated in different currencies, but we're converting it all to US dollars for these estimates. In M3, which again is not just the actual currency, but it's broader, includes checking account balances and even up through money market mutual funds. That's about 80 trillion right now. Okay. Let me do another one just to be completely generous to Bitcoin. Let's double it, because right now, let me just walk you through the economics of it. Right now, when people are deciding on how large of a cash balance do they want to hold, they take into account things like, what's the expected price inflation rate in the future? Like, what's the stability of this currency? Okay, so right now, let's say you're a US citizen and you have $1 million in net worth, and maybe 300,000 is the value of your house. So that means now you got to account for the other 700,000, and maybe you've got 200,000 in the stock market, and you've got some other money that's in fixed income, like safe corporate bonds. Maybe you got some Bitcoin, you've got some gold and silver, and then you have actual US dollars, like $100, $50 bills. Or maybe you got a safe in your house and you have a month's worth of currency in there just in case the banks go down or something. You're a prepper and you have a checking account balance. But my point is, if you think CPI is going to go up 4% a year over the next 10 years, other things equal, you're going to keep lower cash balances, and you're going to instead hold assets that have at least a nominal return, right? Because cash, if you hold actual currency, doesn't give you a return. It just sits there. So if prices in general quoted in US dollars are rising 4% a year, then you're losing real purchasing power by just sitting literally in physical currency. But you still need to hold some currency, right? Most people right now are holding some Federal Reserve notes in their wallets or their purses, or again, like in a home safe or something, or under the bed. Even though that fact is true that I just said, they realize that the real value of that's being bled away. And then, of course, in other countries, it's even worse, where their consumer prices are more volatile than they are in the US. Okay? So that's definitely a factor. And so I'm saying, if the money were more robust and that people knew, oh, I could actually just sit in, quote, cash and just maintain my options, right? Because the problem with getting out of cash and into something that has a return is that that's riskier, right? So again, if you're thinking from the perspective of a US citizen and your daily life, everything's denominated in US dollars, holding actual currency is quite safe in terms of the liquidity, like in a sense, the thing that's the ultimate base money has the ultimate liquidity. That's how we measure liquidity, is how easily can you turn, if you say your house is worth $300,000, and we say, well, how liquid is that? We kind of mean if you had to turn your house into $300,000 in money in a checking account that you could pay to somebody, how long would it take you to do that? That's kind of a measure of the liquidity of an asset. All right. So to say, oh yeah, I have 5 $20 bills in my hand, so that's worth $100. And you say, yeah, but how liquid is that? Say like infinitely. Like, how long would it take me to turn these 20s into spendable money? 0 seconds, because they're spendable money right now. That's kind of the idea. Okay, so the problem with getting out of very liquid assets like currency and into something that's relatively illiquid is that fact right there. And then when you pick something, maybe you picked an asset that is more dubious, right? So you can get into the stock market and you're going to more than outpace standard consumer price inflation over a long term probably, but the stocks are volatile. And even though they're fairly liquid, like if you have a brokerage account and you want to sell off some of your stock portfolio because you want to go buy a car, it doesn't take that long to turn your stocks that are, quote, worth a certain amount of dollars into spendable money. But again, even there, notice you can't go to the car dealership and say, yeah, I want that Lexus, and here's some of my S&P 500 ETF that you can have. That's not the dealer saying, no, I need USD to order to give you this car. Okay, so you still have that issue of converting it. Okay, so my point is, people maintain cash balances right now, even as bad as the money is, the government's issue. So that was Lynn Alden's book that we interviewed. I'll link to this just in case you missed that. Her point is to stress the coming revolution in voluntary, market-produced, blockchain-based money is contrasted to all the bad monies that governments around the world issue. So what I'm saying is, other things equal, right now, if you look at somebody and say how much of their wealth is held in the actual form of cash, even if we define it somewhat broadly as M3, right? So not just saying how much currency do they hold, but also include their checking account, even include their savings accounts, which earn some interest, even including their money market mutual funds. I'm saying the percentage of their portfolio that they hold in money defined as M3 is going to be higher if the money is Bitcoin rather than these relatively awful government issued currencies. Okay. So that's the idea. So what's the factor for there? I'm just going to be somewhat arbitrary here. Let's say it's double. The people would want to hold the percentage of their portfolio that's literally in the form of money. Let's say it's double in the new environment when they're using Bitcoin. So that's one key point of my analysis here where you might quibble with. If you're a Bitcoin maxer, you might say, no, actually, I think when people realize just how great it is to sit in Bitcoin, because again, it won't be volatile. If we get to the stage of global adoption where the hodl phase has passed, the number one strike against Bitcoin right now is it's so volatile. But that won't happen if we get to the period that I'm talking about, where everybody's using it at least as a store of value and maybe the means of settlement for huge transactions. And it can't be debased, right? So it's not just right now what's holding people back from having too much exposure to the US dollar. It's not simply that, oh yeah, consumer price inflation has been high the last few years, the highest, since the early 80s. And even if you think the US government's fudging the numbers and actually grocery prices are a lot higher now than what the government's been reporting, it's not just that, but it's always the possibility. If the Federal Reserve wanted to, they could just engage in another bout of humongous QE and could tank the dollar. So there's always that element, even besides just observed debasement of the currency, if that's the term you want to use. The fact that central banks around the world could completely debase their currency next Thursday if they decided to. Whereas with Bitcoin, that literally just can't happen. It maxes out at 21 million, and we're actually already have mined 19.9 million units of Bitcoin anyway, right? So there's not that much more new supply coming into the system. Okay. So like I say, you might think me saying, let's suppose people hold twice the percentage or the portion of their portfolio in quote money that they are right now. Maybe you think that's unfair to Bitcoin. So you can scale these things up if you want to. But other than that particular one, I think the other steps in my argument are fair to Bitcoin. Okay. So given all that, if right now global M3 is about 80 trillion, then in the alternate universe where everybody is instead holding that in the form of Bitcoin and we double it, that means in today's dollar terms, Bitcoin would have a global market cap of 160 trillion. Okay, so with all the stuff I spent here for the last, 27 minutes or so building up to, that was my meandering way of getting to the point where I'm saying, I think if we want to come up with a ballpark estimate in today's terms of what could possibly be the upper ceiling of what Bitcoin's market cap could be once there's full global adoption and we leave the hodl phase and now we're just in long run equilibrium, that Bitcoin has come into its own, and that the boosters of Bitcoin at that point would say, okay, yeah, it's got nowhere else to go. Now it is what it is. And that's fully matured. And this is what we've been telling you about all along. This is where we were headed. I'm saying in today's terms, I think the most the market cap could be is 160 trillion. Now, you might say, you're talking like that's nothing, Bob. I mean, you could buy a lot of stuff with $160 trillion. Yes, you could. All right. So I'm saying by no means should this episode, and by the way, I have an article up at the Infineo website, folks, if you want to see me spell this stuff out in written form. So yeah, in the article and what I'm saying here is not at all bearish on Bitcoin by any stretch. No, I'm saying come up with back of the envelope numbers. I could see how like the fundamentals of Bitcoin could support, in today's terms, $160 trillion in market cap. So what does that mean though, in terms of the possible pace of price appreciation? And so here's where I think the rub comes in, and that some of the extreme Bitcoin maxis may just not have thought through this really. So one adjustment is, let's take into account the supply issue. So more Bitcoins will be mined between now and the year 2050. Ultimately, I think it's going to go up through the year 2140, but there's the halving that keeps happening. And so over time, the flow of new Bitcoins coming into circulation periodically shrinks. Okay. And so that's the sense in which most of it's already been mined. And then going forward, of the remainder that is still yet to be mined, most of it will happen sooner rather than later, if you get what I'm saying. Okay. So already it's something like 19.9 million have been mined. So roughly 95% of all the Bitcoins that will ever be produced have already been produced. So there's not that much more to go. So just taking the 5% figure, or rather what I'm saying is let's take 95% of that 160 trillion target to say, right? Because if the ultimate market cap of Bitcoin is 160 trillion, but we want to know if I got in right now, what's the price appreciation on my component of that? Well, right now, the existing Bitcoins are only like 95% of that value, if you get what I'm saying. And so multiplying 0.95 times 160 trillion brings it down to 152 trillion. All right. So contrast that with the current market cap of about 1.3 trillion, right? So the number of Bitcoins in existence right now times their market price is a current market cap of Bitcoin of about 1.3 trillion as I'm recording this. All right. So what that means is between now and 2050, if that's the date more, assuming full global adoption is kicked in, that's a rise of about 115 times. All right, or in other words, an increase of 11,500% over the 25 years. So that's still awesome. But when you break that out and annualize it in terms of compound growth, that's only between 20 and 21% a year. So round up if you want. That's 21% a year on average. Okay, so that's the sense in which I'm saying over the last 10 years, remember, it was about 105% average growth rate per year. And I'm saying even with all what I think were pretty generous assumptions packed into there and pulling it forward and saying, let's assume we get total global adoption within the next 25 years, still we're getting 21% growth. Now, let me just address, there's two factors there. There's the price inflation factor and just real economic growth. Okay, so the price inflation, I'm assuming when we talk about like 160 trillion market cap, that's in today's dollars. And so in the year 2050, what today would be $168 trillion market cap, in the year 2050 would be higher. All right, but I don't want to confuse things with that. So what I'm talking about here is real terms. So if you want to tack on like, oh yeah, but I want to think of it as measured in US dollars, for example, then yeah, you could tack on the growth. But what I'm saying here is in real terms, that's like 21% per year. So for example, if you thought average price inflation were going to be 4% a year over the next 25 years in US dollars, then you could say the growth is going to be 25%. All right, but then you'd probably want to make a similar adjustment for real estate or whatever as well. So if you're comparing Bitcoin to other assets that are not dollar denominated, presumably in the long run, those things also are going to respond to just general price inflation. All right, so that's why I'm saying, like, if you want to say, oh no, Murphy, you're totally underplaying it because the dollar, I think, is going to crash. And so actually, Bitcoin measured in dollars is going to go up way more than 21% a year. Right, I agree with you. It is measured in dollar terms, but by the same token, gold and real estate and stocks, especially if it's like global stocks, also are going to rise more in a world where the euro and the dollar and the yen all crash. So I'm just saying to keep it apples to apples and to take that element out of it to just look at the quote real performance of Bitcoin. I'm just keeping that out. And so you can adjust that however you want. But again, if what we're ultimately trying to do is look at Bitcoin compared to other assets, it's not that Bitcoin alone is going to benefit in nominal price appreciation terms or measured against other fiat currencies issued by governments if those currencies do worse over the next 25 years than they have over the previous 25 years. Okay. The other element is in terms of how do you handle the real economic growth? And this one, I went back and forth that I could see an argument either way, like to say, if in general global GDP grows in real terms, then you'd think the economic value of the money stock would also grow with that. So maybe we should tack that on. That's fine if you want to do that. I could see arguments going either way for that, like whether it's double counting or not, but it doesn't matter. My point is, just for this ballpark estimate, okay, so if you want to say global GDP grows at 4% on average per year between now and 2050, then fine, add 4 percentage points to this. If you want to think that some Bitcoin, the money stock would keep pace with that. Also, again, too, the issue there is, wouldn't that also translate to the value of equities and things like that as well? So again, if we're trying to compare Bitcoin as an asset class, there's that element. But either way, however you think that comes down, sure, you can add single digit growth to my annual estimate. But my point is, that's not going to bump it up above 30. And so if what your frame of reference is to say, hey, Bitcoin, its popularity has grown, has been more than doubling on average over the last 10 years, I don't see that that's sustainable, even with these generous assumptions. And again, the huge generous assumption I made was not worrying about transaction costs, okay? That people are not going to be as likely to hold as much in the form of Bitcoin if it's costly to transact with it. That's going to be a strike against it. And I just assume that away, just to be fair, also to keep the analysis simpler. Okay, so big picture, given the assumptions I made, even if we achieve total global penetration and adoption over the next 25 years, such that Bitcoin in today's terms completely displaces M0, M1, M2, and M3, and then people hold twice as much of their portfolio in Bitcoin as they currently hold in all the forms of money aggregates up through M3, still I'm seeing in real terms Bitcoin growing at maybe 21% a year on average up through the year 2050. So that's still a great thing to have. It's not that the current hodlers are going to be slapping their heads and saying, oh man, I only made 21% a year on average for 25 years in a row. Geez. No, there's no other asset class that's going to perform like that, probably, depending on how you define it. But again, the point of this is just to inject some realism into some of the more aggressive speculations that I've seen. Of course, if you disagree with this, I will read the comments under the video here if you're watching it on YouTube, and I look forward to your feedback. Thanks for your attention, everybody. See you next time.